Michael Burry just posted his economic forecast for 2023. What is it? How can it impact you? And how can you benefit from it in the year ahead? If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. You are watching Unrivaled Investing. So let's understand, what is Michael Burry saying? He said inflation peaked, but it is not the last peak of the cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the U.S. in recession by any definition. There's a lot to unpack here. So what is he saying? Well, let's understand. Here's a little fancy chart. So you see consumer price index. It peaked around 9% plus in June 2022. It's been coming down each month sequentially to the tune of around 0.5% per month. This is in response to continued monetary tightening. What Michael Burry is saying is expect continued declines with consumer price index. Continued, let's say around 0.5% ballpark. If you model that out for the rest of this year, for 2023, you're looking at potentially negative inflation or deflation in the second half of 2023. This can create real problems. So let's understand why is this and what are the potential problems. So one should first understand the Federal Reserve significantly overshot inflation. They were doing $100 billion plus in quantitative easing. Inflation was starting to pick up. They said, hey, it's okay. We'll hit that 2%. Massively overshot, went to 9%. Now they're tightening. They're saying, hey, we want to get to 2%. Yeah, they're going to undershoot it. That's effectively what Michael Burry is saying. A lot of smart investors are saying, hey, they didn't have control on the way up. They're likely not going to have control on the way down. So if you have that and you get to deflation well below 2%, what's that mean for the economy? What's that mean for the stock market? Well, once you hit deflation, that means effectively companies are lowering prices. When companies lower prices, that creates real problems because one, your labor costs, your input costs oftentimes stay the same. So your profits fall significantly. As profits fall, you also get lower valuations because folks say, well, wait a second, you're not having that growth I was expecting, and worse, your profits are declining. So you get this double whammy of worse fundamentals and also worse valuation. The psychology gets worse. So that's where you start seeing the stock market drop significantly. I've called out previously, wouldn't surprise me to see the S&P 500 around 3,000 later this year. That's personally what I've called out. Assuming, hey, you have some sort of valuation resetting with the S&P, going to a lower multiple. So that's a core aspect here. Another big problem with deflation is that the debt that companies have taken on during the cycle, it becomes harder to service it because oftentimes you're looking at, hey, the debt didn't decline in value. The debt still stayed the same. And if you have to lower your prices, now it's getting harder to, let's say, cover your interest expense or repay that debt. This creates the risk of a deflationary cycle, deflationary bust. This is part of the reason why the Great Depression lasted as long as it did, is because you didn't have central bankers say, deflationary busts are problematic. We need to intervene. Instead, they said, hey, let's just see how long this plays out. Well, what happens is once one company starts lowering prices, then others start having to lower prices, and you have one company go bust after another because they have trouble servicing their debt. So this requires some sort of intervention, at least to stop the cycle, what can be a very painful deflationary cycle. And that's the second part of what Michael Burry is saying. But if you're expecting inflation to come under control later this year, why is the Federal Reserve still tightening? Well, the reason why is because two key components of the inflation index, shelter and services, was actually still making new highs as of the most recent period, November 2022, still around 7% inflation, multi-decade highs. Well, shelter is expected to roll over in the coming months, partly because mortgage rates have shot up 5-6% versus 2-3% previously. And so you will see that impact. You're starting to see home prices fall significantly. That will impact shelter. Services is tougher. Services includes a big component from labor. That is because of a demand-supply mismatch, and that will become harder to get and harder to lower inflation. What the Federal Reserve is saying is, hey, we can't really control the supply of labor, but we can impact the demand for labor by making it tougher for businesses. And so if they raise rates enough, if they have a tough enough, high enough monetary policy or tight enough monetary policy, you can impact demand. And that's where they're expecting to see services roll over in the coming months. That is why the Federal Reserve continues to have a tight monetary policy where they say higher interest rates for longer. Now, this is where Michael Burry starts getting confusing for some folks because he says, well, the Fed will cut and government will stimulate. So the Federal Reserve will lower interest rates because, you're going to go below that 2% rate, and the government will stimulate. Some of this is automatic because let's say you have unemployment benefits. Some of this is, you have the president or, you have leaders that want to get reelected. And so they put in new bills, say, hey, we got to, fix the economy again. So then he says, we will have another inflation spike. Now that might seem surprising to some folks. And he goes, it's not hard. What's he talking about here? So there's a couple of pieces here. So he's expecting effectively easier monetary policies closer to the second half of this year, the end of this year, but then saying there will be another inflation spike in 2024. What's going on? The reason why is the Federal Reserve and the stimulus from the government, that impacts demand. But what we haven't seen addressed is supply. And if you don't solve supply and you just, tighten monetary policy, then increase it or loosen it and, start printing money again, you're just going to have another problem with inflation. And I'd argue two key aspects of inflation with the supply side that hasn't been solved is one with regards to energy markets, making sure you increase production significantly. Instead you're looking at, I'd argue asinine policies saying, hey, let's do, taxes, boom time taxes for these oil companies. That's the exact opposite direction of what you want. If you want to encourage more production, you don't want to create the uncertainty of what your future return on equity will be, what your future return on investment will be. So that's the first step. Do not say, hey, we're going to do these new taxes on oil companies if you need to increase production. Number one. Number two is the supply market in terms of labor. There's a real challenge there. Jerome Powell talked about several million people not being in the workforce that should be, partly because a lot of folks got out of the workforce because of COVID. Some folks retired early. Some folks just said, hey, I don't want to work that hard if I'm going to be exposed. Why do it if I can get some sort of benefits? That creates a real challenge on the system. The Federal Reserve is driving demand lower, but the supply problem hasn't been solved. Those two key aspects, supply for energy and labor, could create another inflationary spike if the Fed reverses course towards the end of this year, creating inflation in 2024. So this is a lot for investors to digest. So the question is, well, what's that mean for asset prices, investments in the near term? This is a particularly challenging environment. So if you'd like investment ideas for all types of markets, consider unrivaledinvesting.com, where I discuss compelling companies, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. I also recently launched 2 new investment courses for enterprising investors, one on how to read financial statements, and the other is how to understand and think about valuation, how to value stocks. In full disclosure, this is not financial advice. So how can you potentially benefit in this environment? In the very immediate term, cash is probably going to hold its value than a lot of other risk assets where you're facing the risk of potential deflation. The reason why is as you're looking at prices go lower, once again, I already mentioned that can hurt the stock market. You could see much lower prices for risk assets like stock market, in which case stocks, or cash, which yields around 3.8% at Interactive Brokers. There's a link below for Interactive Brokers. That's where I personally, keep my funds and where I personally invest. So cash holds its value versus everything else that starts deflating. If you start seeing economic contraction, earnings recession, stock market gets hit, cash holds its value. So in the very immediate term, I would expect cash to continue to do well relative to the stock market. That's the first step. The next step is potential deep value stocks. And that's the types of thing that Michael Burry typically types to find. That said, if you look at his portfolio, he still did massively trim his portfolio. So it's still tough, very tough to find these types of deep value stocks. When I say deep value, I mean things trading under 10 times free cash flow, and they could return most of that free cash flow to you as a shareholder. The trick is to find very stable and durable businesses. Oftentimes, though, the reason why they trade at, let's say, 10 times or under free cash flow is because there's no expected future growth or there's a lot of debt. So these are tough businesses to find. They're tough businesses to own, and you're generally not looking at the same types of returns as finding something that's a great growth company over a multi-decade perspective. But in this environment, finding those growth companies where you want to find a great growth company and pay a reasonable value for it, that is a very, very tough situation, because if you're looking at potential deflation where companies are lowering prices, that means the growth assumptions that a lot of these companies currently have baked into them will come down. And as growth assumptions get hurt, you're also likely to see valuations also come lower. Now, I personally believe that these types of growth businesses that you want to own over a multi-year, multi-decade perspective, that's where a lot of the investment returns can be for most investors. The challenge is that in this environment, the very immediate term, these types of growth paying a reasonable value is tough because you see that valuation compression and you'll likely see fundamentals get hurt. Now, this is also where you should be building your shopping list, because you're looking for things to say, hey, I want to buy these things that I'm very, very likely to grow at a good clip in the years ahead. I'm going to wait for compelling valuation. So I'd say the growth companies, at a full valuation or even lofty valuation, that's where it continues to get hurt in the immediate term. So that is something to consider in this environment. Most investors saying, hey, I'm paying growth at a reasonable price. Well, is it still growing at that reasonable price if you're facing a tougher economy, and in which case you're getting a lower price? Another aspect or another basket that can potentially do well. So I talked about growth not really holding up. I talked about deep value doing well in this environment because, it trades at such a low multiple of free cash flow. And I also talked about cash. Special situations. Here's a picture of Joel Greenblatt. He wrote a wonderful book called "You Too Can Be a Stock Market Genius." You can see over my shoulder. So that book, was really called out, and Joel Greenblatt delivered something like 40% return for like a decade. So incredible returns. Special situations are where there's some sort of action that's going to happen with the company over, let's say, 6 months or 12 months or next year that can cause it to re-rate significantly. And, one example is a spinoff. And I recently called Brookfield Asset Management. I did a video on Brookfield. In full disclosure, I own some Brookfield stock. I talk more about it to my subscribers at unrivaledinvesting.com. Spinoffs, though, are just one type of special situation. Sometimes you have other situations where a company sells an asset and they're looking to buy another. And so I'm actually currently looking at a company that trades around their cash balance, and they're looking to deploy significant amounts of cash to buy a company, in which case the stock could re-rate, several 100%, 2 to 3x potentially in the next year. So I'd argue that special situations, those types of things can hold up better in this environment because there might be unique aspects to it. Some sort of action, maybe some sort of deal merger goes through, so those are the types of things that even if you're facing a recession, a special situation can hold up or even outperform in a very tough environment. So if you enjoyed this video talking about what Michael Burry is calling out, saying, hey, you're looking at potential deflation in the second half of 2023 because of monetary policies hurting demand, and potential inflation in 2024 because, yes, the demand came down, but we didn't solve the supply problems. That's why he's saying, it's not hard. There's demand and supply, basic Econ 101. If you enjoyed this, sort of explaining this and what works in this environment, cash in the immediate term, deep value, potential special situations, while getting your shopping list ready for multi-year perspective, that the growth at a reasonable price. If you enjoyed this, please make a point of hitting that subscribe button, hit that thumbs up, and thanks so much for watching Unrivaled Investing.